Well, hello.
Oh.
I don't know if there's a moderator or if we're
That's
just supposed
me.
to chat.
Apparently I'm the
Oh,
moderator.
you're the moderator.
Yeah, I just found out.
Wonderful. I like this. I also love these headphones. This is a whole new addition.
This
Yeah,
is like
this is really nice.
It's like the silent DJ parties.
Yes.
So who's playing the music? We have one more speaker joining us, but we're going to kick off, and I guess we can use the first couple of minutes just to get ourselves introduced to the audience, and then as the other person joins, we'll ask him or her to do the same. So I'll start with the far corner. So Reeve, if you don't mind just giving a slight intro and maybe your specific interest in stablecoins.
Wonderful. Well, happy to be here and happy to see all these technological advances. Yesterday was another conference where half the audience had some interpreter headphones on, which I thought was a really cool touch as well. But anyways, excited to be part of the Cardano ecosystem. My background is, first and foremost, when I dove into the blockchain in 2013, was with the creation of Tether, so the advent of the stablecoin and putting the dollar on the blockchain. Since then, all right, welcome.
Thank you. It's good to be here.
Yeah. Since then, have had a handful of crypto projects. The one after the creation of the stablecoin was really the creation and the rollout of the NFT. So concepting what a digital token would be that was really non-financial in nature. And now, back 10 years later, a full circle to launching another stablecoin called Treasury X. But this time around, it's with the Web3 ethos in mind. Like, how do you empower and enable and reward the community for participating? Because it's been a decade and we're a much more mature market now. And for stable coins, they are such a profitable space. That's why you're going to see 1,000+ of them roll out. It only makes sense now that we have the tools and the technology to ensure that the community is the one that actually gets the most rewards, because they're the ones providing the value and the participation. So. Yep, that's the future.
Great. Well, we're glad to have the co-founder of Tether on our panel, so thank you. Yeah. And of course, now with your next iteration, we can see a Google instead of the Yahoo, right? So there we go.
Exactly. Let's hope.
I'm going to pass over to the far left, and if you could just take a couple minutes to introduce yourself and a specific interest in stablecoins.
Sure. So my name is Robert, and I've been involved with crypto for quite a time now, and I got started in Bitcoin back in 2013 and kind of got interested in stablecoins around the time that TUSD came onto the scene. So I really got interested in like the synthetic asset space and how to bring more assets on chain, like real world assets. And then a couple of years ago got into Cardano, and I created the iUSD stablecoin on Cardano, and then most recently I created the myUSD stablecoin on Cardano, so that's one of the top stablecoins right now. So this has kind of been a big interest of mine, you can say that, for quite some time now. I'm really just wanting to bring more utility into the blockchain ecosystems so that people can transact and store their wealth freely without borders.
Awesome. Thank you so much.
Hi everyone, so my name is Benoit. I got involved in the stablecoin through the acquisition of the startup I was working for at the time by Circle. So I was working for a Taiwanese-based startup called Saibavo, who was working in Europe, and at the time Circle was looking for a wallet provider to expand in this sector. So got involved with Circle in really boosting USDC and Eurocoin in Europe up until earlier this year. And now I jumped into a new project, which is called Stable Mint, which is a very ambitious European-based project backed by CoinShares. And really the goal here is, to create this kind of European-based player to boost any sort of stablecoin that we see on the rise, because as of today we see like obviously USD and Euro, but I think the future really lies into more what we could call local stablecoins. So looking at Eastern Europe, looking at North Africa, obviously looking at Middle East, where we see a lot of things happening. So very excited to be part of this revolution.
Awesome. Yeah. Did you say local stablecoins?
Yes, that's how I would call them, at least.
Cool. Awesome.
So I'm Matt Plowman. I have a background in traditional finance. I've worked at Deutsche Bank for 15+ years.
We will not hold that against
in the money market space, and I'm the founder of the USDM stablecoin, which is Cardano's homegrown fiat-backed stablecoin, regulated in the US along the same lines that USDC is regulated, Today we published our MiCA white paper, so we'll be live in Europe very soon. And so I think it makes us the second, US-based MiCA stablecoin that will be issued in Europe. So Cardano's largest fiat-backed stablecoin, homegrown from the ecosystem.
Wow. So am I correct in saying we have both IUSD and USTM on the
My USD.
My USD.
By Mint.
That's good. That's right. That's a fiat currency backbone. Is that correct?
No, it's collateralized by other stablecoins. So currently it's collateralized by USDC and USDT, and then we're looking into integrating like USDM and USDA as they come on board.
Awesome, awesome. So there's different panels that you've probably been to, and sometimes they go around and say, can you comment on this and comment on that? That's not my style. I want us to have like super interactive debates. You're all adults. Please speak up if you have an opinion. If you don't speak up, you will not be heard and you won't have something to say. Awesome. So I'm going to throw the thing open to the floor and say two things. Cardano has had very limited success in stablecoins. It's about 8% of TVL versus like Ethereum, which is like 250% of TVL. What's the reason for that? Especially we've got two stablecoins that are native to Cardano. And then I've got a few more things coming your way. But comments from people?
That's an easy one. Like, we haven't had stablecoins for so long, and so like Cardano kind of grew organically with just ADA. And so that's how the DeFi kind of came into the world. And very unlike with Ethereum, that kind of grew alongside USDC and USDT. And so you have a lot of the DEXs that are paired with a stablecoin. We didn't have that for a long time. And then like the first stablecoins were synthetic assets. And people naturally don't trust synthetic assets compared to fiat-backed stablecoins. And so they didn't get widespread adoption. And so it wasn't until very, very recently we got USDM, and that is getting some very quick traction.
So what's the way for getting more trust behind the stablecoins?
Yeah, I think that a lot of that comes out of the stablecoin design. So the original stablecoin on Cardano was JED, and then quickly followed by IUSD, that has this stability mechanism that is based on ADA. And that's one good way to go. ADA is the dominant asset in the Cardano blockchain. So the way we designed USDM is to have smart contract controls, decentralized reporting. So we have an oracle that reads the values of all of our bank accounts and all of our reserve accounts and prints it on chain. And then the minting can only occur if that oracle confirms that there's sufficient reserves.
So you get like a proof of reserves.
So there's an on-chain proof of reserves. It's enforced by the smart contract in Cardano.
And do you think that's sufficient? Because Circle had arguably a proof of reserve, but they also got depegged during the crisis with Silicon Valley Bank and Signature Bank. Is that strong enough?
The depeg, though, comes from just fear. It's not nothing to do with the backing or the mechanisms. It's just fear.
Yeah, I was over there when it happened. So
were you afraid at the time? Were you fearful?
Personally, I wasn't because I mean I was on the Circle team. We saw obviously a lot of people fear what's happening, but I think it was really a chain of unfortunate events that happened, and obviously us we were very confident because, to be frank, even if the whole money was lost, we definitely had the liquidity to back up and to stay alive. But more importantly, I think is that what is important for our industry is that it was the first time that it was banking introducing risk into the crypto space. Yeah. And I think actually it helped us.
That's a really good way of putting it, yeah.
Yeah, because we survived it very, I would say, easily. A lot of calls over the weekend and a lot of crisis management. But really we got from that stronger as Circle, but also as an industry. And we can go confident to now traditional players and saying, look, actually blockchain, crypto, and what we're doing here could be considered as safer than the traditional finance.
And the proof of reserves mechanism is really a tool for increasing the confidence in the coin, which helps to increase adoption. So it doesn't necessarily increase on-chain stability. On-chain stability is brought about by the individual dynamics of the liquidity markets that exist on that chain or on the different on and off ramps that serve that chain. So the more opportunities you have for an individual to get $1 worth of value from the stablecoin, the tighter the peg will be. So you look at the Tether and you look at USDC, there are many opportunities to get $1 worth of value without having to actually convert it back into that fiat dollar.
Would you agree with that?
Well, absolutely. That's the entire purpose. And in the beginning, when I created Tether and tried to describe it to people, because people just didn't understand, I'm like, think of PayPal. PayPal is like a Tether. Is like Tether. PayPal this isn't technical, but PayPal could be seen as its own blockchain. You transfer your cash into PayPal, it moves around, you transfer your cash out. It's identical. So back then in 2013, 14, that's the only way people could register. I'm like, now you transfer your money onto the blockchain, we issue tether, it moves on a blockchain. When you need to move it out, you move it out. However, again, look at PayPal and how many people keep their money in PayPal because there's so many use cases. And obviously time has proven that there's lots and lots of use cases for a dollar on the blockchain, mainly trading, and it is what is enabled tons of exchanges to come, like pure crypto exchanges to come online, and then all of the trading pairs. And so people don't need to go in and out of the stablecoin. There's no point. You just need to accept the stablecoin. And when you mentioned earlier about risk and about how Circle depegged, you know, everyone always has this big fear about Tether depegging. And back when that happened, I went on the news quite a bit because they said, oh, Tether depegged or Tether's going to depeg. I'm like, Tether has never once wavered, not even a hundredth of a penny from its peg. It's always and at all times has been completely redeemable for exactly $1. It's just that you have to redeem it from Tether. So all the exchanges are third parties, and obviously the supply and demand on that exchange is what drives the price on that exchange, and you look at CoinMarketCap that has the average price of all those exchanges. Yeah. And so people just don't understand the dynamics of it. There is no depegging because it's $1. You just need to redeem it from the bank account. And then over time, like this gets into, okay, what makes a stable coin worth exactly $1? And then you can look at the backing. So in the beginning, it was, okay, we're always going to have 100% reserves of cash backing the stablecoin. And that's what it took to get industry acceptance. Yep. But then over time, we realized, okay, banks have less than 10% reserve. Why does a stablecoin need it? And then, think about how much grief Tether got from converting from pure cash backing to treasuries, which is just, you know, about the lowest risk you can get. And then they've expanded to a few other things, but it's majority of treasuries. And then it goes on to the other types of backing, which then you could back it with algorithmically, which hasn't been proven to work quite yet. Yeah, and then baskets of crypto. Yep. And now what we're introducing is backing stablecoins with RWAs. So an RWA would be, the first one will be a treasury, but it's an on-chain treasury, so tokenized RWAs. And then the list of assets that we can use to back stablecoins, and this is what I feel is so exciting about the future of stablecoins, is that the new type of backing that we can do that provides even higher yield than treasuries, but just as safe, especially when you put in the right mechanisms that the technology can offer.
Well, one of the struggles that turns into, though, is you actually become monetary creation. And to the extent that central banks want to have a monopoly on monetary policy within their jurisdictions, you run afoul of a very powerful enemy. And that's a challenge that, when you think about the TradFi industry, money market funds take cash, invest in short duration commercial paper and whatnot, and they don't create money, they just transfer money and create money that is, or they take money and then they transform it into something that can be traded on brokerage rails. So we're taking money that can be transferred onto blockchain rails. And the moment that you say we're going to take an under reserve, or we're going to take an asset and then use, you create more than 100% of that asset in money, then you actually end up in an expansionary monetary policy state. And there's risk there that maybe isn't appreciated by the industry.
Are you creating more than 100% though?
Well, if you're under reserved, then you're creating money.
Reserve, but then you're breaking covenants, though, right? You need to have a collateral that matches that, unless you get like what the banks do.
But as you start with the algorithmics, right, then you end up doing that.
So, is there a double standard here? Because I mean, and again, I want you guys to. This is great. You guys are getting all under the lead. The less I speak, the more successful this is. One point, regulation. Now you talked about local. Is it really local, or is it more like global? And is the EU actually fostering a stablecoin industry or fostering a euro-denominated stablecoin protectionist industry? And will the regulators change? Will they actually make this more like banking, where your core capital is what's required and the multiple of that is what's in the market?
I think what many jurisdictions are overlooking is the strategic aspect of stablecoins and RWAs in general. The way to look at it that is quite simple is, what is Circle doing right now? They're distributing US debt globally. So when you buy USDC, and you sell euro for it, you sell your euro to get USDC to actually invest in US treasuries. So I think at some point what's going to happen is many countries are going to wake up to this fact. And if you think about the future on-chain, as we would love, I think, all to build, which is literally putting the world on-chain, do we see a world, a future where 100% of the world is tokenized in USD? I'm not too sure that every country on earth would be happy with this kind of future. So that's what I'm looking at, and that's what I think. Obviously, it's a bit further down the line, because what we need to build right now, and that's why us at Stablecoin, we will start with the USD and Eurocoin, like you have to, because you have to have this settlement layer. I think Stablecoin has this new settlement layer on top of blockchains and the blockchains that were built so far. But the future of that is really, to bring literally all of major currencies across the globe and being able to settle, having a true fungible stablecoins that we were just talking about, being able to go from one stablecoin that is on one chain to another stablecoin that could be same fiat dominated but on another chain seamlessly. I think to your point about earlier about Revolut or any app of this kind, is it's funny to see that banks right now, especially in Europe and in the US, where we see cash disappear. We see the future. They really want us to get rid of cash for whatever reason we know. So actually, your dollar in your bank account right now, do you need to off-ramp from it or on-ramp from it? Like, you can actually look at it this way. And so in the future, if you have a USD in your bank account, a USDC, a USDT, or any other on any other chain, well, at the end, it's still a dollar. And what you want is just to buy stuff with it or to invest, get yield on top of it.
Which is great from a utility point of view, but back to the regulation, right? Because 88%, call it 90% of the world's trade is settled in the US dollar. Yes. So where's the incentive to go beyond that?
Well, why is that the case? It's largely
America's number one.
Because Americans. It's largely the petrodollar gave rise to dollarized global exchange, international trade, and the kind of current international order is largely dominated in U.S. dollar as an extension of that. And to the extent that the U.S. continues to have look at blockchain askance and has a very weak regulatory regime regarding blockchain, it really risks the dollar dominance in this industry. So to the extent that we kind of draft on the fiat world, if the blockchain industry were to say, well, we can't do dollars anymore, what are we going to do? Well, we'll do the next best currency, which might be euro, which might be something else that could be a good blockchain-based world of exchange. And if we do see that future state like you're talking about, where the entire world is on-chain, the U.S. could lose its advantage in that marketplace.
And I've been pushing that narrative for years to the different governmental agencies. It's like, why on earth would you restrict tether? We are ensuring that dollar is the reserve currency of the blockchain ecosystem. Yeah. Like, what on earth are you doing to, or Circle? Why would you restrict this? You should support it fully and ensure our dominance, because the blockchain ecosystem is only getting bigger and bigger. But that was the first thing that they couldn't comprehend or believe that it's going to get as big as it is. But yeah, it's a huge risk that the dollar won't be the reserve currency.
And that's where we've seen like an advantage with Europe. So like USDM is based in the USA, right? But we've kind of had some difficulty getting foothold there. It's really difficult to get a bank account, especially if you're not in the USA, if your team is not centralized there. As soon as you mention dollars and crypto, like the banks just kind of shut off. So you end up going to these offshore banks. It's really hard to do banking onshore. So we have set up our business in Europe, and it's relatively easy to kind of get into the compliances there. I mean, there's a lot of bureaucracy, lots of paperwork involved. But once you're in the EU and you're working with euro instead of dollars, it's relatively straightforward. Like I have found that Europe is more crypto friendly compared to the USA. But the caveat is like you can't have dollars in Europe. So that does lead way to having euro-denominated stablecoins. But what we haven't yet seen is like the demand on chain. Like everyone has been wanting dollars, and I think that's just more of a first mover advantage. But Europe is setting up that pathway to kind of allow for more.
So globally, about 16% of global reserves are in the euro. Whereas in the stablecoin world, 0.3% of stablecoins are euro denominated. So yes, there's a big delta there, and that's probably where the opportunity is. But shouldn't that be driven by the market? Why limit the total volume of US denominated transactions for a stablecoin in Europe under MiCA?
That's a really good question to ask, like the regulators, right?
Any regulators in the house here?
Yeah, and to your point, what I found fascinating in what's happening right now is, for once, I would say, Europe is kind of the forefront. And yes, it had a lot of bureaucracy through MiCA, but as you said, once you're in, and the vision is clear, the regulation is clear, and that's why I'm actually equally excited with what's happening here in this region, in Middle East, because we see those clear regulation coming in play. They should be quite effective in several months. And this is just great for us, because once you have the rules, businesses, what we want is just clear rules. Give us the rules, we'll do the rest. That's all we want.
I mean, if you turn back the clock a little bit to when we thought, post Brexit, we're thinking about Grexit and Ital exit and maybe Deutsche exit. We wanted to think about the stability of the euro itself as a currency, and I can imagine why these regulators, with that memory so fresh, would want to avoid anything that challenges euro dominance within the European Union.
Still protectionism. So, okay, great. We all agree that regulations this is required to foster. So the market is predicted to go from about 120, 150 billion today to about 3 trillion, right? So you have this like 17, 18 times increase over the next, say, 6 years by 2030. Mm-hmm. Is it going to be fear or fantasy that drives us, and what's going to be the element of both? Is it RWA fantasy, or is it protectionist fear?
The fantasy that's driving it to 18 trillion, or what? It's the utility that's driving it to 18 trillion.
Yeah.
Is that a new technology paradigm has been introduced a decade ago called blockchain. It connects the world in a really efficient manner. It connects the world in a way that you can transact with just because you're connected through the internet. And so it's taken this long for people to realize that. And so the $18 trillion is the fact that all financial services are going to move on-chain in some way, shape, or form. And that way, shape, or form can still be driven by governments, and a lot of this 18 trillion is CBDCs and traditional financial transactions just moving on-chain.
And it's really about banking the unbanked. So like you see the clear use cases of stablecoins in the Latin America region, in Southeast Asia, and we have found that it's really hard to sell stablecoins to Germans and Americans and Canadians because they have good banks, right? And you have these Cash Apps and Venmos and Revoluts, and you have all these apps where I can send money to another person in an instant. And so to them, a stablecoin is like, why would I do that? Because at the moment, it's not a good user experience. That's where we really need to accelerate and make it simple. We need a cash app for crypto. But where we do see adoption is in Latin America, especially where they have high inflation. They lose money every single paycheck because they're earning money in their local currency. And so what do? They end up going to the black market. So that's really what we need to kind of eliminate, is like, rather than risking and like kind of bypassing laws, like we need some frameworks in place, and we need the tools so that people anywhere in the world can just get access to on-chain dollars. And once they are on-chain, they have so much more opportunity. And I think that's where you can also expand with the Americans and the Canadians and everyone in the developed countries, because they're usually restricted in just like their regions. But once you get the on-chain dollars, they can then expand. Like, they're not expanding at the moment because they have so much opportunity within their own regions, but we're moving into a globalized world.
So you think of stablecoin usage, there's trading, there's purchase, the purchase of digital assets, and now increasingly purchase of non-digital assets in the form of RWAs. Is that going to shift globally when Canadians want to buy tokenized real estate in Egypt, for example? And second, is it also going to be institutional-led, or is you see it very consumer-driven?
I would agree with Reeve, is it, that the tokenization of the world will turn into the need for more money to serve that tokenized world. I don't think that there's going to be a mass exit to stablecoins for no reason. There has to be a reason to need that dollar on chain. And the need for that dollar on chain comes from maybe need to do payments, maybe need to do your banking in a secure fashion when you don't have safe and secure local institutions. But those things need to, adoption begets adoption. And to the extent that we can have the world's global financial system changing stocks, bonds, real estate onto an on-chain fashion, then that's where the
So
drive
do you see a
will come for
correlation then
stablecoins.
between stablecoins and RWA? And
Yeah,
tokenization?
absolutely.
Oh, yeah.
Yeah.
Yeah,
Okay.
they will come together. I don't see tokenization happening without strong stablecoins because you need to have a denominator for it. How are you going to tokenize European real estate without a euro stablecoin? And as you were saying about Egypt, I could say the same. So that's much needed. And just to your point as well, one thing we didn't talk so much about is just literally importers, exporters. When you're a big company based in Europe, like despite not looking at the just individual sending money, but you're a big importer. You need to pay this guy in Latin America. You need to pay this producer in Africa. How long does it take to pay? And these guys, they're still not equipped with what it needed to have the infrastructure to handle blockchain payments, etc.
Yeah.
So
then
it's going to come there.
So then they get an invoice from their supplier,
Yeah.
and they ask the supplier to round up the invoice so that it matches the current official exchange rate. They go to the central bank and they get the foreign currency, and then they go and use that foreign currency to pay because they have this invoice, and they end up with a little bit of a delta onto their advantage. But the difference between in Latin America, blue market, black market, whatever you want to call it, exchange rates and the official exchange rate is that opportunity for blockchain.
Yes.
And can you see stablecoins backed by things other than fiat, maybe not synthetics, RWAs? Can you see, I've heard of oil-backed stablecoins, commodity-backed stablecoins, precious metal-backed stablecoins.
Absolutely. This is really my interest as well. Like, right now we're in this stablecoin era, but like this is just the first phase. The reason people want stablecoins is for reducing their volatility. Now, the actual denomination isn't really relevant to long term. People will want to make bets on what they think will appreciate in value over time with low volatility and will go increase in value against inflation. But that can be any sort of commodity. And so I really envision a future where we're going beyond just fiat-backed stablecoins, where it's like a basket of commodities. So like gold has been like the gold standard for a long time, and we're beginning to see that come on chain. It doesn't yet have much utility because there's not much driving factors to use it. But like as people get more comfortable with the technology, as it becomes improved, we can start to do some really cool, innovative things, such as like take a basket of these commodities, tokenize it, and now that's an inflation hedge, and you don't have government risk. So yeah,
so
definitely.
it would probably be with the rise of asset liability matching. So when you think about the region, many of the currencies in the Gulf Coast region are pegged to the dollar because the primary export is oil, which is denominated in dollars. So the primary monetary coming into the system is dollars, and so you're very, very tightly tied to the dollarized world.
Right.
So you need that price stability. And to the extent that you need gold-backed stablecoins or you need other commodity-backed stablecoins, oil-backed stablecoins, it's because you need to find a way to match that asset with liability that you have on the other side. And then if the world is going on-chain, then we also need to have all of those assets to have a similarly backed coordinated token. I don't know if it would be called a stablecoin, but it would be, certainly that would be, in our current parlance, what we would need.
There'll be thousands and thousands of stable coins because just like think about television. When we grew up, there was 3 channels, and then there was cable, and there was 100 channels, and now there's millions of channels of TV, right? Every TikTok is its own channel. And it's because, why? Not because the content got any better or different, it's because the technology was there to make it super easy. So in another 5, 10 years, the technology today is there to spin up a stable coin, but the technology, the regulations, and the use cases will be there that everything's going to be tokenized, and so they'll back everything. And so again, just like TV, a lot of those channels get very, very, very little volume or very little viewers, and some get a ton. And so I think there'll be every flavor of stablecoin possible, and it will attract whatever community it appeals to.
And then as we move into that world, we need an issuer agnostic settlement layer. So whether it's a USDM issued by Moneta, whether it's a USDA issued by Ansys, whether it's a USDT issued by Tether, there needs to be a way. Right now, it's this cottage industry of companies, and although Tether is big when you compare it to the worldwide monetary supply, it is still a de minimis amount. And as banks come online to issue their own stablecoins, there'll need to be a fungibility between all the stablecoins, and so there'll need to be a uniform settlement layer so that any stablecoin that is of equal quality can be accepted by its peers, and then the fiat gets slided around as it needs to.
Matthew, you think that's what drove the acquisition by Stripe of Bridge last week? One of probably the biggest acquisition ever made by Stripe, worth $1.1 billion, which I don't think got full media attention, just given the consequences of this and the kind of thinking that went into this purchase?
Actually, that's what is getting me excited right now. Like, because what we see is Bitcoin 70,000, we see those big acquisitions, we're here talking about all these revolutions, and there's no media attention. This is just great. Like, I just can't wait for what's going to happen next, because in next 6 months, what's going to happen? You know, when you're going to cross the 100, 120K, then all of a sudden people are going to wake up, and we'll be here, we'll be ready, and we've been building since then, so I'm loving it.
Okay, that's good to know you got excited about it. And do you think this is then going to be a replacement? Because ultimately what stablecoins also do is allow for faster, cheaper transactions on a price-stable basis. And we do have arcane systems like ACH in the US, and you can argue SWIFT is also, you know, in need for a few retools. Do you see a stablecoin layer globally becoming efficient? And do you see this bridge as one potential candidate for that?
I mean, Bridge is some company that we worked with closely, actually, because we're kind of going after that same market where we want to connect the world with payments. So you should be able to send a payment no matter where you are to whoever you want. The good thing about Bridge is like they created that infrastructure layer where you could just take one stablecoin and redeem it for another stablecoin.
Which is what you were saying, Matthew, right? So to me, like that's the layer they're building. So your JP Morgan stablecoin is exchangeable for
they basically were a white label stablecoin issuer. So that was our interest, right? Because we just need a stablecoin, right? We don't really care about managing our own stablecoin. So that's why we kind of reached out to Bridge and started to form a partnership before they got acquired by Stripe, because they can bring white label stablecoins and stuff like. We can envision this world where you can have like these stablecoins that are controlled by communities, and then they might have their own incentive programs. It's kind of how you have this proliferation with like credit cards. Like everyone can issue their own credit card, they white label it, they have their own rewards and loyalty programs. We're probably going to see that with stablecoins, and a facilitator like Bridge is like the perfect company for that infrastructure layer.
Yeah, the way I look at it is actually stablecoin, I think, could become marketing tools. As simple as that, which is what you described. Just everybody will have their own little marketing stablecoin kind of thing. And in the back end, there will be the builders, like we ensuring the security, the safety, the backing and all that, and take off this lift from the brands and then have fun.
And if we're going to talk about issue-agnostic stablecoins, we need to also talk about blockchain-agnostic stablecoins. And so I believe that this bridge layer, if it's not going to be Bridge, it's going to be some kind of consortium amongst the current stablecoin makers that would then turn into a cross-chain future where it doesn't necessarily matter which chain the coin is issued on. Then we can get a unit chain layer below, we call it layer 0, whatever, layer X. So there's various projects that are in that. And I think that the more cross-chain stablecoin adoption we need, the more cross-chain integrations we have. And that's really what's going to drive this kind of unit chain future.
So I've got to cover 2 points with these. So what does this mean for, if you don't have a specific network that's going to be more adept for stablecoins, what does this mean for the Cardano network? And is this going to be the cross-chain network where Cardano is one of them, or is there a certain efficiency that Cardano brings about that makes it more friendly and more efficient?
I mean, you can dream all you want, but you have to execute
where
people are. Right? You need to execute where people are.
Right.
And so the blockchains have communities that are loyal to them. Cardano has a very loyal community, and to the extent that we can serve that community by building a fiat-backed stablecoin when existing fiat-backed stablecoin infrastructure isn't compatible with the UTXO architecture, then we can get there. But we need to understand where people are, build what they need, and then build the future.
And that's what actually I'm quite excited about building stablecoin on Cardano, because I believe Cardano is one of the few chains that is quite true to the values of blockchains and what it was designed for.
That's right.
And so, as I was saying, local stablecoin, I believe it's very much aligned with this vision of letting people do what they need to do and giving them the options to really use this tech for their own advantage and not just trying to speculate on this or that.
Okay, so we got about 3 minutes left. I got 2 predictions to ask you. Within this plethora, this multiverse of different stablecoins, there's an argument that people want yield-bearing stablecoins. And some people would say that's one of the requirements. It's just the way you use stablecoins for transacting, buying, trading. Savings is one of them. what percentage of that, say, $3 trillion market or whatever number you want to take, what percentage of the market in 5 years from now will be yield bearing out of the whole set, and why so? And what's your prediction on the US election and where that takes us? Let's start with Robert at the end. You've been very smart with all your comments so far, so we're all ears on you right now.
So we actually have a yield-bearing stablecoin for Cardano, and so like we see that as like a main use case. I don't know about making prediction of percentage, but from the users that we've talked to, like everyone wants to make money on their money. So I would say like a high majority, like more than 50% of people are going to want something that replaces their bank account because they're tired of these 1% yields in their, or they're losing money to inflation. So that's going to kind of be a big driver. And then in terms of like the political sphere, like I do hope that we get some more clarity for coming out of this U.S. election. At the moment, there's only one candidate that's giving us that clarity. So let's just say, yeah, I'm hoping that we do get that clarity, and it's looking likely.
I love your diplomatic answer. Fantastic, Robert. You should go to politics. My vote's on you.
Yeah, I'll echo that sentiment. You know, I definitely believe Trump is going to win, and I think it's amazing for our industry, especially because he's going to bring in Elon Musk and a handful of other extremely intelligent people. At least that's what he says, so let's see if he ever follows through any of his promises, not that any politicians do. Because it's nothing about the man, it's about what hopefully that they're going to deliver. And then as far as yield-bearing stablecoins, unfortunately or fortunately, but I believe that the majority will be yield-bearing, and it's not if it's logical or not, because getting a yield-bearing stablecoin for payments doesn't make that much sense, but it's more how people feel. If they're sitting on money they want to earn, and if they have an option of one that earns and one that doesn't, they'll probably choose the one that earns, even if it's immaterial.
Fantastic.
Yeah,
Benoit?
I don't think I'm not sure what I could add to that. I definitely echo this sentiment where yield bearing has to be built in. I think a lot of people feel ripped off by the bank, and just like, how come you make so much money on top of that, and me, I'm just getting this, you know, small percentage. So again, with the ethos of blockchains, which is, you know, giving power kind of back to the people and their finance, I think it will be a very large portion of it.
So and is Trump going to give power back to people, or Kamala? Can't dodge that question, sorry.
No comment.
Father Kamala. Okay.
I'll be something of a contrarian. As a builder who lives in the world, like the real world that can't dream, just has to look at the current regulatory environment. In the U.S., stablecoins are regulated on a state-by-state basis. They're treated as gift cards. They're not allowed to pay interest.
That's true.
In MiCA, there's no interest-bearing stablecoins allowed. So once Trump wins in a 48-state landslide in 2 weeks, we'll get a real regulation that treats stablecoins as they should be treated, instead of under this current regulatory regime.
Fantastic. Well, that was a really good way to summarize it, Matthew. Thanks to all the panelists for your time. A big hand of applause, silent and non-silent. Thanks for your wonderful insights.
Thank you.
Thank you, Robert. Thank you, Reed. Thank you, Benoit. Thank you, Matthew.
Thank you.